Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to this special series on life goals brought to you by Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the fourth session on tax planning, and that is tax planning through mutual funds. In the last few sessions of Money Simplified, we took you through tax-saving investment options under Section 80C of the Income Tax Act 1961 and how aggressive as well as conservative investors can go about tax planning. Moving forward in this session of the tax planning series, we'll elucidate how you could undertake tax planning with mutual funds. As you may know, mutual funds offer diversification across asset classes. They offer a variety of plans and options. They are professionally managed and are well regulated. They offer low minimum investment and convenience of SIPs, that is systematic investment plans and economies of scale. They also offer tax efficiencies. They offer high liquidity for open-ended funds and offer the potential to earn high inflation-adjusted returns. So if selected wisely, they potentially reward you well for the risk taken. Moreover, tax planning is also possible through mutual funds. Here are types of mutual fund schemes you can consider for tax planning. Number 1. Equity-linked savings schemes. These are also known as tax-saving mutual fund schemes. Distinguishing features about them are they come with a lock-in period of 3 years. The minimum investment is Rs 500 and there is no upper limit. Both lump sum and SIP mode is available for investing. For SIP mode, each unit will need to complete the lock-in period. Withdrawals are allowed post-lock-in, and dividends and capital gains are tax-free. The amount invested in ELSS qualifies for a deduction under Section 80C up to a sum of Rs 1.5 lakh per annum. If you have a high-risk appetite, that is, you are an aggressive investor, ELSS funds may be a predominant portion of your tax-saving portfolio. But don't invest in ELSS blindly or just by the past performance because it may or may not be sustained in the future. Look at the risk taken to generate the returns, portfolio turnover ratio, expense ratio, and other portfolio characteristics. Also, while selecting, you may give importance to those which have completed at least 5 years of track record and are from mutual fund houses that follow strong investment policies and processes. Also, while you consider ELSS for tax planning, don't approach it as a 3-year product because of the lock-in period, but more as a product to achieve long-term goals which are generally more than 5 years away. Next, Rajiv Gandhi Equity Savings Scheme or Rgss. This scheme was introduced in the Finance Act 2012 under Section 80CCG that provides for deduction for investments in Rgss. But only new retail investors who comply with the conditions of the scheme and whose gross total income for the financial year in which the investment is made under Rgss is less than Rs 12 lakh can avail a deduction by investing in Rgss. New retail investor inter alia shall mean any resident individual who has not opened a demat account or who has opened a demat account but has not made any transactions in the equity segment or derivative segment. The maximum investment permissible for claiming tax deduction under Rgss is Rs 50,000. As an investor, you would get a 50% deduction of the amount invested from the taxable income for that year under 80CCG. The benefit is in addition to the deduction available under Section 80C. First-time equity investors can invest into units of mutual funds and ETFs under Rgss. Rgss also includes eligible listed equity or follow-on public offer of such listed equity. The total lock-in period for investment under Rgss will be divided into fixed lock-in period and flexible lock-in period. The initial period of the lock-in shall be known as fixed lock-in period, which shall commence from the date of purchase of the securities in the relevant financial year and end on the 31st day of March of the year immediately following the relevant financial year. A new retail investor shall not be permitted to sell, pledge, or hypothecate any eligible securities during the fixed lock-in period. The period of 2 years beginning immediately after the end of the fixed lock-in period shall be called the flexible lock-in period. Upon the completion of the fixed lock-in period, new retail investors would be allowed to trade in eligible securities. Investors would, however, be required to maintain the level of investment during the next 2 years, that is the flexible lock-in period, at the amount for which they have claimed income tax benefit or at the value of the portfolio before initiating a sale transaction, whichever is less, for at least 270 days in each of these 2 years. Such investment value shall exclude the value of investment which is under the fixed lock-in period. If you have a high-risk appetite, that is, you are an aggressive investor but new to investing in equity, you may consider Rgss for your tax-saving portfolio. Next, pension funds. Those who are moderately conservative can consider pension funds. Debt-oriented pension funds typically allocate a predominant portion of their assets in debt and the rest in equity. They have a higher potential of wealth creation over the long run than assured return products owing to the equity component. However, pension funds do carry some element of risk vis-a-vis assured return products owing to their market-linked nature. The amount invested in pension funds qualifies for a deduction under Section 80C up to a sum of Rs 1.5 lakh per annum. All debt-oriented pension funds are subject to long-term capital gains tax (LTCG) post-indexation benefits. Pension funds can be an effective tool to plan one's retirement. At the vesting age, that is after you retire, you may choose to withdraw fixed amounts at regular frequency through systematic withdrawal plans (SWPs) to meet your retirement cash flow needs. Learning by example. Now let's say you are a new retail investor and your gross total income is Rs 11 lakh and you have invested a sum of Rs 1 lakh in ELSS, Rs 50,000 in Rgss and Rs 25,000 pension funds. For deduction under Chapter 6A of the Income Tax Act, you can avail Rs 1,25,000 as deduction under Section 80C for investments in ELSS and pension funds put together, while for Rgss, 50% of the amount invested, that is Rs 25,000 under Section 80CCG. Therefore, the total deduction you can avail will be Rs 1,50,000. This will help you reduce your net taxable income or NTI to Rs 9.50 lakh, and so will the tax liability to Rs 1.18 lakh as per this table. The other aspects of tax planning through mutual funds. Besides holding ELSS, Rgss and pension funds, one should be cognizant of the holding period while holding other mutual fund schemes. Holding period has an impact on short-term capital gains and long-term capital gains tax. Having said that, if the exit from a mutual fund scheme becomes necessary owing to consistent underperformance or any other negative reason, you may give priority to redemption to cut further losses rather than calculating tax impact. We will discuss the tax implications of investing in mutual funds in our ensuing lecture. Here are a few vital points to remember. While you endeavor to achieve your long-term financial goals, mutual funds can also help you in tax planning. But select mutual fund schemes prudently. While ELSS has a lock-in period of 3 years, don't approach it as a 3-year product but more as a product to achieve long-term goals. Rgss is available only to new retail investors whose gross total income in a financial year is less than Rs 12 lakh. Maximum investment permissible for claiming deduction under Rgss is Rs 50,000. You can get a 50% deduction under Section 80CCG of the amount invested. ELSS and Rgss are suitable for investors with high risk appetite or those classified as aggressive investors. Debt-oriented pension funds are suitable for moderately conservative investors. Nevertheless, they carry some risk as predominant portion of the assets are invested in debt and the rest in equity. Pension funds can be an effective tool to plan one's retirement. Be cognizant of the holding period while investing in mutual funds to avoid tax implications. If the exit from a mutual fund scheme becomes necessary owing to consistent underperformance or any other negative reason, priority may be given to redemption to cut further losses rather than calculating tax impact. So complement tax planning and investment planning. So to end our learning exercise today, we now invite you to test your learning by taking this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.